Good morning, everyone, and welcome. Today, we're diving into a comprehensive overview of residential mortgage funding. We'll be exploring the key sources, the main participants involved, and the mechanisms that drive housing finance. This session will give you a clear understanding of how residential mortgages are funded and the important roles each player has in the process. Let's get started. Residential mortgage funding comes from a range of sources that work together to keep the housing finance system running smoothly. These include traditional financial institutions like banks, government programs that support access to home loans, private investors, and specialized lenders focused on mortgage financing. Financial institutions and lenders are crucial because they actually originate the mortgage loans that home buyers rely on. Meanwhile, government programs play a key role by making mortgage financing more accessible to a wider group of people who might otherwise face challenges obtaining a loan. The mortgage lending ecosystem itself is quite complex, involving banks, government agencies, participants in the secondary market, brokers, and others, all contributing in different ways to the process of originating, financing, or purchasing mortgage loans. By understanding who these participants are and what they do, we gain a clearer picture how mortgage funds ultimately become available to home buyers. When we talk about depository institutions, we're referring to traditional sources of mortgage funds like banks, savings and loan associations, and credit unions. These institutions play a crucial role in the housing market by originating mortgage loans. They do this primarily using funds they collect from customer deposits, such as savings and checking accounts. Unlike some other lenders, these institutions often offer retail mortgage products directly to consumers and usually continue servicing the loans throughout their life. This ongoing relationship helps maintain a steady flow of mortgage credit. Their local or regional focus means they are deeply connected to their communities, making mortgage credit more accessible and reliable for many home buyers. Fannie Mae and Freddie Mac play a crucial role as government-sponsored enterprises in the mortgage market. Their primary function is to buy mortgage loans from lenders, which allows those lenders to quickly replenish their funds and offer more loans to home buyers. After purchasing these loans, Fannie Mae and Freddie Mac bundle them into mortgage-backed securities, or MBS, which they then sell to investors. This process of securitization is important because it helps transfer the risk associated with the loans and significantly increases the amount of capital available for mortgages. Ultimately, this supports wider access to home financing, making it easier for people to purchase homes. The Federal Housing Administration, or FHA, offers mortgage insurance that helps protect lenders. This protection allows borrowers to qualify for loans with lower down payments and more flexible credit requirements, making homeownership more accessible. Both FHA and VA loan programs aim to increase homeownership opportunities by breaking down credit barriers that might otherwise make it difficult to buy a home. Specifically, VA loans provide valuable benefits to eligible veterans, including government-backed guarantees, often no down payment, and favorable terms. These programs are designed not only to help borrowers, but also to manage risk for lenders, striking a balance that encourages lending while protecting financial interests. When we look beyond traditional banks and government programs, private investors play a significant role in residential mortgage lending. These investors provide additional capital that helps support the housing market. One key vehicle for this is mortgage real estate investment trusts, or mortgage REITs, which pool together funds from multiple investors. They use this capital to either buy existing mortgage loans or originate new ones, as well as invest in mortgage-backed securities. This activity increases the overall pool of available funds for home loans. Importantly, private investors and mortgage REITs often focus on niche areas or offer alternative financing options, which helps to complement and diversify the broader mortgage market, ultimately benefiting borrowers and the industry as a whole. Mortgage brokers serve as intermediaries, helping borrowers connect with a variety of lenders to find the best mortgage options tailored to their needs. While they play a crucial role in facilitating the mortgage process, it's important to note that brokers usually do not fund the loans themselves. On the other hand, correspondent lenders take on a different role. They originate and fund loans using their own capital, giving them more direct involvement in the lending process. However, these lenders often sell the loans shortly after closing to larger institutions or investors. Together, Mortgage brokers and correspondent lenders expand access for borrowers and promote greater competition in the mortgage market, ultimately benefiting home buyers by providing more choices and better terms. The secondary mortgage market is where mortgage loans and mortgage-backed securities are bought and sold after the original loans have been created. This process allows lenders to take loans off their balance sheets, which frees up capital for them to issue new mortgages. A key feature of this market is securitization, where multiple loans are bundled together and sold to investors. This pooling spreads the risk across many parties rather than concentrating it in one place, which helps manage risk more effectively. Overall, the secondary mortgage market plays a crucial role in maintaining steady mortgage lending and contributes significantly to the stability of the broader financial system. Direct seller financing happens when the seller of a property acts as a lender, allowing the buyer to purchase the home through credit extended directly by them. This method is especially helpful for buyers who might struggle to get a traditional mortgage, often due to credit or income challenges. One of the benefits here is the flexibility in terms, meaning the repayment schedule and conditions can be tailored to fit the buyer's situation. However, it's important to note that this flexibility usually comes with higher interest rates and shorter repayment periods. The reason for those higher rates is that the seller is taking on more risk by financing the purchase themselves. Overall, direct seller financing can be a useful option in certain cases, but it comes with both advantages and important considerations. Specialized lenders are financial institutions that offer short-term or higher-risk mortgage loans, which don't usually meet the criteria of conventional underwriting standards. For example, hard money lenders or certain finance companies fall into this category, often working with borrowers who have weaker credit or who need financing for unique or unconventional property types. While these loans tend to come at higher costs, they play a crucial role by providing funding solutions when traditional lenders aren't an option. Essentially, specialized lenders help bridge those financing gaps, making them an important part of the lending landscape. Here, we're looking at the key differences in mortgage funding sources. Depository institutions like banks and credit unions offer stability because they have established customer relationships, but their funding relies heavily on deposit inflows. On the other hand, government-sponsored enterprises, or GSEs, bring liquidity to the market and help create a standardized approach to mortgage funding, which can make borrowing more predictable. When we compare private investors and REITs to seller financing and specialized lenders, we see that private investors and REITs contribute capital diversity, meaning they bring different sources of funding into the mortgage market. Meanwhile, seller financing and specialized lenders play a crucial role in meeting non-traditional mortgage needs, often catering to borrowers or properties that don't fit the conventional lending mold. Together, these varied sources help keep the mortgage market flexible and responsive,